David,
Yes.
Here in Monte Carlo, a lot of reinsurers have seen some of the best margins in decades. Clients argue that protection is becoming importable. Do you think reinsurers are striking the right balance between profitability and clients' needs, or is there a risk of pricing themselves out of their relevance?
Well, of course, reinsurance is a form of capital like equity and debt, and it goes through pricing cycles just like equity and debt. In fact, if you look at this chart, and we'll send you our report, but if you look at this chart in our report, it's a measure of economic value add for reinsurers, and you can see that over the long term, reinsurers and insurers also, by the way, they tend to deviate around 1% or so economic value add. The difference, as you point out, for the last few years is that reinsurers have been earning lots of economic value add, and there are a lot of reasons for that. That is now moderating, but it's still relatively high in historical terms, as you allude to. So the question is it too high, and should reinsurers come back down? And of course, this is a decision for reinsurers. They have to make their own underwriting decisions based on their own profitability metrics. But what I would just say, looking at it from the other way, if you are a reinsurer now, even though we are past the pricing peak, as they say, and we're in this era of hard market softening, it's still a very profitable market for reinsurers generally. When you look at the amount that they're assuming from cedents, and when you look at attachment points, when you look at even pricing, and I know that this is possibly a controversial thing to say, but we're not in a soft market. We are still in a hard market that is softening. And so if you are able to select risk, if you're able to innovate, you can make a profit in this market. And as you allude to, perhaps even more importantly, you can do so while making your clients happy, because in this market, your balance sheet as a reinsurer is so valuable to clients, especially in a world where interest rates are elevated, where inflation is high, where costs of equity are high. Insurers are hungry for reinsurance capacity. So it's a great time to be underwriting. We can restore that partnership between insurers and reinsurers. We can make a profit, and we can help our clients.
Everyone in Monte Carlo talks about climate change, but critics say the industry is still far behind on concrete climate action. From your perspective, is the insurance market doing enough, or is it climate talks outpacing actual progress?
Of course, the insurance and reinsurance sectors can do more around climate risk. And just to be clear, we are aggressively trying to address climate risk as best we can. I mean, there are... So I guess we probably should talk about wildfires. Wildfires are a function of fuel, aspect, slope, wind speed, and climate. Those are the 5 factors that affect wildfire. The Los Angeles wildfires, and I'm sorry to go to Los Angeles, but they're just so big, they're hard to ignore. We think that they'll be ultimately upwards of 40 billion in terms of the insured loss, and the economic loss will be perhaps several times that. So that's quite incredible. But one of the things that insurance companies are doing in terms of wildfire risk, and I'll just focus on that for a moment, is that insurance companies can help municipalities and countries remediate climate risk. And they don't need to do that by withholding insurance. That would be wrong. What we can do is we can help people in communities that are vulnerable to climate risk to build fire breaks, to cull forests, to make sure that there's sufficient water available in places where there are heavy population concentrations. And the very important thing is to get the private sector into the market so that all of the risk of climate doesn't fall on the public sector. And in order to be able to do this, the risk has to be attractive, it has to be profitable for private companies to underwrite. So we as private insurance companies can help states, municipalities, governments, countries take those remediative actions to bring much more efficient than raising taxes and taking it from the public purse, to bring insurance capital in to address climate risk. And it really is the same thing with all perils. So I'm in favor of that ground-up positive approach rather than the top-down restrictive approach.
Alternative capital was once expected to transform the insurance market, yet traditional players remain dominant. Has the ILS experiment under-delivered, and what would it take for capital markets to truly disrupt the industry?
I think that ILS has transformed the market. If you look back 10 or 15 years, or if you go back 20 years, I mean, ILS, or if you want to call it convergence capital or alternative capital or third-party capital, as a percentage of total dedicated capital was just a couple of percent. It's now, by our measurement, and we are conservative measurers of dedicated capital, but by our measurement, it's nearly 25%, or it's definitely in the low 20s. So that's huge. And if you look at the capital inflows post-Hurricane Ian during this cycle, ILS is the primary channel through which capital is flowing into the sector. This is in great contrast to post 9/11 and post Katrina, when most of the new capital coming in was through the traditional channel. So I would just say, actually, ILS continues to come in. It has transformed the sector. It certainly did in the teens, and it's now just part of the furniture. So I think it's here to stay, and all that I'm wondering about is where does it go next?
We've seen a wave of consolidation among brokers and reinsurance. Howden has taken a different path, emphasizing independence and culture.
Yeah.
Is consolidation ultimately weakening client choice, and how does Howden intend to resist to that trend?
We in Howden definitely see ourselves as the broker of choice. So if you think about the broking market, and if you've been in the market for a really long time, maybe 20 or 30 years, the shape of the broking market in economic terms is what is referred to as a logarithmic oligopoly. There are usually one or two or three big players at the top, and then there's a couple of medium-sized players, and then there's a tail. But it's a Pareto frontier. It's sort of an 80-20 ratio. And we just think that in that 80%, there needs to be more choice, for sure. If you're a client and you're buying reinsurance, if you're a corporation and you're buying insurance, you don't want to be restricted to one or two brokers. That's, contrary to free market and open market competition. So we absolutely think that it's crucial that we and others are able to compete in a free and open market, and we're definitely going to do that.
Thank you, first of all, for all the things that you share with us.
Not at all.
By closing, I would like to ask, what do you expect to achieve from this year's Monte Carlo?
It's amazing just looking around this room here and thinking about Howden Re and where we are now and where we were 6 years ago. I wouldn't have believed it if you would have told me 6 years ago that we would be here. I know some people had more vision than I did, but my goodness, look at it. So it's very exciting to be out here with our report, Who Dares Wins. And Who Dares Wins really has two themes. One of them is about us, Howden. The other is about the industry. And we have just come over the pricing peak, as you allude to. We are now in the hard market softening phase. If you will, in most lines of business, the pricing tailwind is gone. So this is the phase of the market where insurance companies and reinsurance companies can continue to be profitable, but to do so they must innovate. They must have access to the best business intelligence, the best data. They also have to execute, and they have to be able to transact. And our job here as Howden Re is to get people the very best possible deal that we can, given the current market conditions. And we do that with strategic advisory, we do that with capital markets, we do that with facultative business and MGAs, as well as treaty broking, the core business. So it really is a multifaceted approach, and that's what we're trying to achieve here.
Quickly before we close,
yeah.
AI, do you think it's a danger for the underwriter's work, or it's a useful tool?
I am in the camp that it's a useful tool. I mean, we all have AI on our phones right now. We can all, my children can probably use AI better than me. But AI is not a differentiator unless you have a homogeneous, structured data set. And that's what we've built in Howden with Nova. And so we think that if you have structured data in terms of pricing, claims, buyer behavior, by line of business, if you have homogenized data from statutory authorities, from public authorities, you can now query that very rapidly, but you have to have the data. So if you have the data, AI is a great competitive advantage.
Thank you so much for everything you shared.
It's a pleasure.
All the best for this year's Monte Carlo.
My pleasure. Thank you very much, Kostas.